Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day and sharing it with us. Wow, what a run the stock market has had since the election just over 1 week ago. I guess it was this time, or maybe a little earlier this morning, 1 week ago, that we all learned that the new president of the United States will be former President Trump once again. And the market really liked it. We saw the market surge higher that day, I guess 1 week ago now. And really, for the most part, the market hasn't given back those gains. In fact, we've seen the market continue to move higher, I guess, based on the idea that former President Trump, once he takes office, he will be much more friendly to the business community than I guess the last administration has. So we're going to talk a lot about the effects on the stock market of the U.S. election. And well, actually, let's pull up our list today of things we're going to be speaking about. Our first topic, actually, is an interview. We have an interview with the CEO of Destination Toronto. His name is Andrew Weir. And for all of you that live in the GTA, I guess we can't help but to see all the hype. Taylor Swift, probably the biggest star on the planet, is coming to Toronto for 6 show dates. And what does that mean for Toronto? What does that mean for Ontario and our country? How much money are these concerts going to generate for the city, for the province? We're talking to the CEO of Destination Toronto, and he will tell us all about that. Top 3 things to consider over the next 10 business days. This is where we get into all the things that make a difference or should matter to investors before you make your investment decisions. Markets react to election results. We're going to talk about the winners and losers. As I said off the top, a lot of winners since the election results were announced about a week ago now. And unfortunately, when you have a lot of winners, there are still some losers. We're going to talk about some of those losing investment ideas, and perhaps it's just a short-term phenomenon, but we'll put things into perspective there. What should you do on a hot trading day when markets are surging? We saw one week ago. What should you do as an investor? Should you jump in? Is that fear of missing out as the markets are moving higher? Or should you just kind of hold back and see how things are? We'll address that as well. Will Canada need to cut taxes following the U.S. election? We've heard that former President Trump, or President-elect Donald Trump, is talking about cutting taxes, perhaps cutting taxes to the lowest rates in the world today on the corporate side. Should Canada think about cutting tax to be competitive with our neighbors to the south? We've spoken about this in the past, cutting taxes in Canada. And you recall a few weeks back or a few shows ago, we had 3 accountants, 3 tax specialists talking about that very topic. We'll address that again as well. Quick hits, 3 ideas, 3 things that we see in the news a lot today. I'll give some perspective on these 3 ideas. I'm sure a few of them will be very familiar to all of you. And finally, your questions. Take a question from our audience. I actually had a question in the last couple of weeks that I wanted to address on today's show. And we'll see if we have time to address any more questions that all of you watchers may have. So if you do have a question, please put it in the chat box. We would love to answer it before the end of the show. And if we don't get to it today, definitely we'll answer it over the next couple of weeks before our next show, or even answer it on our next show as well. So without further ado, let's move on with the show and move on to my interview with Destination Toronto's Andrew Weir, CEO of Destination Toronto. I'd like to welcome Andrew Weir, President and CEO of Destination Toronto, to the show. Andrew was named President and CEO on May 1st this year and has been a member of the Destination Toronto leadership team for 18 years, most recently serving as Executive Vice President. He has served on numerous tourism industry boards and was chair of the Tourism Industry Association of Ontario from 2021 to 2023. I want to welcome to the show, Andrew Weir. Thanks for coming, Andrew.
Thanks for having me.
My pleasure, my pleasure. So I guess what a buzz exists in the city right now. I'm sure I don't have to tell you. I know it's Taylor all day, every day, I'm sure. It's quite amazing. You have we have the hottest star on the planet coming to our city for, 6 shows, right? I think 3 and then there's a bit of a gap, and then another three shows after that. It's, I guess last month you were speaking to the media and you indicated that with the six upcoming Taylor Swift concerts in Toronto, it could generate as much as 152 million in direct spending and 282 million in economic benefits. Can you provide some details around where you're getting those numbers from and those expectations?
Yeah, absolutely. I mean, what an opportunity we have as a city here. This is just a global phenomenon, and it really shows what the power of major events is in terms of driving visitation, driving new business, new spending into the economy. So those numbers you cited, they come from, I'll talk in a minute about how we get to it. But essentially what we're seeing is an overall economic impact of $282 million. And that's made up of the first 150-ish million, which is the transactional side. It's direct spending. So that's what visitors to the city for the concerts will spend on hotels, on restaurants, on Ubers, and on other shopping and other activities they may do while they're here. But it's the money they spend when they're here. But the good news is that money doesn't stop working just because these people then get on a plane and go home again. That's new money coming into our economy. It didn't start the day in our economy, but it ends there and then continues to recirculate. So there's another $130 million that is what we would call the induced and indirect economic impact. So for example, when we spend $100 at a restaurant on a dinner, the restaurant then turns around and respends that same money. They'll spend it on labor. They spend it on ingredients. They may hire a design firm to redesign their menus or some signage in the restaurant. That's all new spending in our economy. So that initial $100 doesn't just stop at the first transaction. It continues to work. That produces tax revenue for multiple levels of government, particularly at the federal and provincial levels. It produces labor income. So there's an enormous economic impact. And again, what's important is this is new money coming into our economy. So it's how we grow our economy. And this shows you that events are critical drivers of doing that because people travel for what they're passionate about. So when you have an event like this, it brings thousands, tens of thousands of new people into the destination and all that spending. And this study that we did just shows you what that impact looks like.
Yeah, and it's amazing how you can track that, right? I guess, you have the initial spend and then that, like you said, that $100 or whatever the spend is goes into perhaps hiring more people or, generating tax revenue for the government, et cetera. It's interesting how far it can go and how you actually can track it. Because I guess a lot of the effects are temporary, right? If you're hiring more people for whatever reason because of the amount of tourism coming into the city, I guess at some point, will those people be, is it just temporary work and at some point they will no longer be needed? To track that, how hard is it to track?
So the calculation is done using an industry accepted economic model, and it's called an input output model that measures economic impact and tax revenue generation and labor income. And it's done by a company called Tourism Economics, which is a group, the tourism unit within Oxford Economics, based out of Philadelphia, and they use this formula. So destinations around the world, and particularly North America, use this to evaluate the impact of concerts, sporting events, and in particular, organizations like us use it to evaluate major meetings and conventions. We host hundreds and hundreds of major meetings and conventions every year, and it's important to understand what the value is. We know that the spending generated by those kinds of events is enormous, but the impact is even greater. So this is a well-established model that measures that. So of course, we don't track every individual transaction and follow it through, but the Oxford Economics has done a lot of work in understanding how that money flows through a system. And ultimately, there is leakage, right? Some of the money eventually does leave our economy. It doesn't all stay within. But in Toronto, because we have a diversified economy, a very high proportion of that money stays within the economy. And it's one of the reasons that we took the unique approach. Other cities haven't done this in measuring things like Taylor Swift. We excluded ticket sales from the economic analysis because that money doesn't necessarily stay in Toronto. That money is going initially to the concert promoter that's not Toronto-based. And then once ticket holders, once people have bought the tickets, those tickets are bought and sold a number of times in many cases on the secondary market. We don't know where that money goes. So we entirely excluded ticket sales, just like we excluded airfare. So when people fly here, we've excluded their airfare from the economic model. Now, some of that would stay here. There are jobs at the airport. There are jobs in aviation that support that, but we excluded that. So, if anything, we're on the conservative side, I would think, in our modeling. But it's a fairly standard formula that's used across North America. What you can change are some of the inputs. So, how many people are coming from out of town versus local residents going to the
Right.
concerts. And again, as I said, we excluded some of the costs because our estimation is that more of those costs don't that money doesn't stay within the city. So I think it's a fairly clean look at what the economic impact really is for Toronto.
And it's incredible numbers. And we've heard people talk about Swiftonomics, right? You hear the effects all over the world. I actually had the privilege of seeing her concert over in Europe with my daughters in the summer. So great concert. I guess she's on stage for like 3 hours performing. Why do you think Taylor Swift, seems to have such a significant economic impact? We obviously many concerts throughout the year. Why is this so special? Why the big economic impact?
You know, People travel for what they're passionate about, and fandom, people that are fans, it's incredibly powerful. We see it with sports, right? We saw it when the Raptors had their championship run. We see it in with concerts. We see it with food. People travel for what they're passionate about, and Taylor Swift seems to have connected with global fans in a way that not a lot of artists have. There's something, if anything is unprecedented in her popularity, it's the direct connection that fans seem to feel with her. And that's what motivates people to travel. Now, as it relates to this particular concert tour, we have the benefit of having among the most shows of any city. I think only LA had more shows than Toronto does, also being at the end of the tour. So that means that all those people that didn't get a chance to see her and all these other stops in North America and Europe and elsewhere, they've got to come to Toronto or the final three shows in Vancouver. So, we've got 6 of the final 9 concerts on the tour. So it positions us very well because, as you said, and obviously your own personal experience, people do travel for this. People travel for what they love. And this show in particular, this tour in particular, is really motivating people to travel. And we in Toronto are very well positioned to take advantage of that because we've got 6 concerts. We're at the end of the tour. And don't forget, we've got terrific global air access too. Don't underestimate how important that is when you're trying to attract people from all over the world, again, whether it's for a concert like this or for leisure travel or for these major meetings and conventions that we host, this kind of global connectivity that we have, it's easy for people to get here from just about anywhere. So that's a competitive advantage that we have that's so important. And again, we see it in other types of tourism, but certainly that's the case in a concert tour like this. So people that want to travel to see the show here, they can.
Yeah, and being one of the largest cities, obviously in North America, that definitely, as you allude to, it definitely helps. I'm just thinking off the top of my head, I've got a chance to see many people come to Toronto concerts. I don't recall 6 shows from anybody putting on 6 shows in Toronto. Do you recall any concert ever having the effect that Taylor Swift concerts are having? I don't remember myself. I remember back in the day, the Michael Jackson days, Michael Jackson craze when I was younger, but nowhere near, from what I remember, the craze that Taylor Swift is bringing to this city.
I don't know that there's a full precedent for this. It's exciting to see you know, Taylor hasn't come here yet, but within a couple of weeks, it'll be in the rearview mirror. So it's important to look at what's ahead as well. And then you look to next summer when you've got 4 Coldplay shows already announced. You've got Oasis coming and doing relatively compact tours, not going to a lot of cities. So for Toronto to be on that list is important. And for Toronto to have multiple shows is really important. And that speaks to, again, some of the short-term and long-term benefits where you have in the immediate term, you've got the transactions, you've got the visitor spending that's generated and the secondary impact from those. But there's also a very important reputational lift that comes with hosting these shows. People are taking note that Toronto has 6 Taylor Swift shows and 4 Coldplay. And this is one of the cities that Oasis is coming to among a very small list. So that sends a signal that something's happening in Toronto. This is a market people need to watch. This is a city that people should be traveling to. And that has a very, very positive reputational lift. It helps shine a light on Toronto more broadly. The same thing will happen with the World Cup in 2 years. All of these things are very, very positive. When big things happen in a city, people take note. And this is a city that big things happen. And frankly, we should be looking for more big things to happen in the city to continue to be in that global spotlight that we know that major events can provide.
Yeah, no, for sure. And I guess turning a little bit to tourism in general, there have been some headlines I've seen over the last few years coming out of the pandemic that tourism in Toronto has been relatively flat. And has that gotten better? And obviously the Taylor Swift concert's coming now. Is that the perfect timing to kickstart things if tourism has been flat in our city?
Yeah, I think I'd characterize it differently maybe and look at it this way. We obviously came out of a period for obvious reasons during the pandemic when tourism slowed way down. And for a period of time, all of our visitors were from within Canada because no one else could travel here. So the real process that we've been going through is rebuilding those more diverse markets, particularly international markets and the major meetings and conventions and business travel side. So it's just been a constant rebuild. So, how I would characterize it is we are continuing to recover and we're most of the way there. So, the good news is we're most of the way there. The bad news is we're still only most of the way there. Here we are 5 years later and still in recovery mode. So, the US market, for example, is about 85% of where it was. Again, good news is it's 85%. Bad news is it's only 85%. So, we're not growing where we were relative to 2019. We're still coming back to those levels, which was really the high watermark. But it is growth, and we are seeing return of visitors. And I think Toronto is well positioned to see continued growth in the U.S. market. The international market, looking beyond the U.S., is a little bit more of a mixed bag, where we've seen very positive return of visitors and growth out of the UK, Germany, those well-established markets. Mexico had been growing very strongly. We had quite a setback with the when the federal government imposed new visa requirements on Mexican travelers. But I think that decline is largely built into the market now, and we're once again building quite strongly in Mexico. We just had a setback and now building on a lower base, but it's coming back again strongly once again. The Asian markets have been much slower in coming back. China in particular, because we don't have direct flights right now, or very few. Again, there's signs that that will change in the months ahead, but a slower recovery there. And then business travel has also just been a little bit slower to recover. We've seen the demand for major events come surging back because we saw during the pandemic that you just can't replicate major meetings and conventions online. We can have a one-on-one conversation virtually like this, but those meetings and conventions and conferences that just cannot be replicated online in any meaningful way. So the demand for those has come back, but we just lost a couple of years of sales because for 2 years, the meetings that are happening in this year and 25 and 26, those were booked in 2020 and 21. And in those years, nobody was choosing Canada. Those major US groups that we're so reliant on, nobody was choosing Canada from those markets because our border was closed. So we're going to see the impact of those 2 to 3 years of difficult sales when we lost that whole pipeline. That impact is being felt right now in 24, 25, 26. So it'll take a couple of years to really all of this to work its way through the system. We've been able to put a lot of new business in, attract a lot of new business to the city, but it doesn't quite replace what was lost. So that recovery is still taking time. And I think we're on a positive trajectory, but it's going to take time for that fully to work through the system.
And, hopefully, in some ways, a weaker Canadian dollar may help a little bit there. Seeing some of our neighbors from the south coming up again, so I'm sure a weaker dollar versus the U.S. dollar might help a little bit. Their dollars, and even Europe, come over here. Their dollars can go a lot longer, a lot further than the dollars down in the U.S. I thought we'd end with a question on maybe a little terminology. I know you sometimes talk about visitor economy and how it's more broad or broader than tourism. And I thought for everyone that may come across this whole idea of visitor economy, what's the difference between the two, tourism and visitor economy? Visitor economy is more broad, is that correct?
Well, I would argue they're the same thing, but I think people's understanding of them might be a little bit different. And so when we say the word tourism, many people tend to think about the leisure side of tourism. They think about people that are traveling on a vacation, maybe coming for a Taylor Swift concert or something else like that. And it's much broader than that. There are many, many drivers of tourism. People travel for a lot of different reasons, and And so we've used the words the visitor economy to be more all-encompassing, but really I think you can use the two quite interchangeably. But when we talk about the visitor economy, we're talking about all the drivers of inbound visitation. And a big part of that is business travel. It's about those major meetings. It's about um, individual business travel, when someone needs to travel to meet with, maybe go to their company's head office or meet with their ad agency or something like that. That's part of tourism. And what we also find is that the businesses that benefit from tourism are much broader. Of course, we think about hotels and restaurants and the usual things that we as travelers tend to consume. We don't often think about audiovisual companies or our meeting planners, those or staging companies that are so critical to the major events industry, which again is such an important part of our tourism economy and our visitor economy. So we use the phrase the visitor economy to be as inclusive as possible, because the reality is inbound visitation and tourism affects so many businesses and so many people and so many communities that it's important that we use language that feels like it represents the entirety of that universe, and because it is so broad, and that you see that $282 million that Taylor Swift is generating, and the same is true, different numbers, but the same concept is true for major conventions, major sporting events. And so in order to convey the idea that so many businesses and communities and so many parts of the city and so many jobs are dependent on that inbound spending, inbound visitation, that's where the language of the visitor economy comes in. So it's really saying the same thing, but just trying to capture the full scope and scale of the impact that visitation has in our community.
Well, Andrew Weir, President and CEO of Destination Toronto, I want to thank you so much for being with us this afternoon. It's been a pleasure learning about the Taylor Swift effect, Swiftonomics. I think everyone's excited when she gets here, see her concert. As I said, I've had the privilege of seeing it already, and it's something to see. A lot of excitement. I'm sure the city will be buzzing when she's here. So thank you once again for joining us.
Great. Thanks for having me.
Thank you. I want to thank Andrew Weir once again, President and CEO of Destination Toronto, for a great interview and talking to us about Swiftonomics, a term that I guess we've all come to hear about and to see and follow over the last 6 to 12 months as Taylor Swift has made her way around the globe with her concerts. And by the way, great concert, as you heard in the interview. I had the chance of catching the concert over in Europe this summer with my girls, and just an unbelievable experience. So thanks to Andrew. Now we come to the part of the show where I talk about 3 things that I think are important for individual investors to consider before they make their investment decisions. As you can see here, number 1, after a big run in the markets, you got to stick to your discipline. And we saw a big run after the election. Markets really rallied, and a lot of individual investors, sorry, there's a train going by outside. A lot of individual investors, they decided to hop on that momentum. Some didn't. We're going to talk about what you should do when there is a big surge in the market. Stick to your discipline is what I always say. We'll touch on that. NVIDIA earnings. They report earnings on November the 20th. NVIDIA is now the largest company in the world by market cap once again. Why is NVIDIA so important? We're going to talk about that. And November 20th, big day for the markets, big market mover. And the third point I wanted to touch on, American economic indicators to watch. We're going to get a bunch of US data coming out, and already some of it has come out this morning. CPI, Consumer Price Index, inflation numbers coming out and telling us or showing us what the inflation picture looks like in the US. So again, another few data points that I think investors should be looking at before you make your investment decisions. So let's talk about the first point, another big run for the markets. I say stick to your discipline. Some would say no. You want to go in there full throttle, try and make as much money as you can, try and get in and then perhaps get out by the end of the day, perhaps get out the next day. Some people try and time these types of markets. I always say stick to your discipline. And the recommendations I made to individual investors while we saw that big surge last week was, if you are going to be a buyer, you want to be a buyer for the right reasons. If an investment represents good value, makes sense, has a good story behind it, and all the data behind the name, the fundamentals. If it makes sense, then yeah, sure, you could buy. But just because there's a lot of hype going on in the markets, I don't think you just want to just plow into the market and throw caution to the wind. Our first chart actually shows the S&P 500 and how much it gained. As you can see right here, we had the election on the 5th and how well the markets did shortly thereafter. An unbelievable gain in the markets. I think the Dow was up something like 1,500 points that next day. The S&P was up, TSX was up, the NASDAQ was up. Every market in North America, every major index in North America was higher. But again, I think you need to stick to your discipline. I think you need to stay diversified. You don't really want to just jump into anything. Our next chart shows here sector performance. And when you look at all the different sectors on the S&P 500, S&P 500, largest index in North America, 500 companies, you can see here year-to-date numbers, which is your middle column, how well all the different indices have done. An opportunity for those looking to build nice diversified portfolios. Well, you can, because you're getting gains or experiencing gains in many different areas of the market. Now, one of the reasons why I say, if you just jump in with both feet into the water when you see the markets moving significantly higher and you have that fear of missing out on these gains, and I say no, you shouldn't do that. You want to stick to your discipline. I think the next chart really shows this. And we have a chart of JP Morgan, JP Morgan Chase, the largest bank in the United States and one of the largest banks in the world today. On that next day that the market opened up, and when we found out that former President Trump will be the next president of the United States, names like JP Morgan and other major banks moved significantly higher. Well, what happened the next day, the second day after? You see a pullback in JP Morgan stock. Now, I will say a lot of the gains or most of the gains have been held, meaning JP Morgan stock did not give back all the gains. And in fact, before we came on the air this afternoon, JP Morgan actually was higher again today. But you can clearly see that if you don't stick to your discipline, if you just go with the flow and buy just on a whim, if you will, or just because that's what everybody else is doing, that's what the herd is doing, you can see that if you would have gotten into this stock, let's say late in the day on the 6th, for example, well, you may have experienced a small bit of gains, but then that next day you would have lost those gains and probably been in the red for that trade, at least initially, at least temporarily. So it is very difficult to just buy because everybody is buying. I think when markets are moving as they did last week, right after the election, you want to stick to your discipline. Buy if it makes sense. It makes sense from a valuation perspective. If it makes sense from a technical perspective, fundamentals are working. That's why you make a buy. You don't just buy because everybody else is buying. So one thing I want to say, and I guess one of the points before you make your investment decisions over the next couple of weeks, stick to your discipline. The markets are high right now. Things are moving in the right direction for the most part, which is great, but you want to stick to your discipline. Second point I wanted to touch on are NVIDIA earnings. And everyone knows NVIDIA, it's been the hottest stock on the planet. Taylor Swift, the hottest star on the planet. Well, NVIDIA, been the hottest stock on the planet for the last couple of years now. And it really has become, and we can pull up a chart on NVIDIA here. It's done so well. You can see here how well it's done. We've had a few minor pullbacks along the way, but we're at pretty much all-time highs right now. And being at all-time highs, if we pull up our next chart, which shows market capitalization for the biggest companies in the world today, and if you pull that up here, you can see that NVIDIA has now become the largest company in the world, largest chip maker, largest tech company, but largest company in general, surpassing Apple and Microsoft, the other two $3 trillion companies that exist today. And Alphabet, over 2 trillion, Amazon, 2 trillion, Meta and Taiwan Semi, a global chip maker, over 1 trillion. And again, most recently, with the recent surge after the election, Tesla shares have now gone up significantly, and Tesla is back to being over $1 trillion. And you can see there, Berkshire Hathaway, Warren Buffett's company is just about to reach the $1 trillion mark. But NVIDIA is so important because of its size, because how much it means to the market, to the index. We have another chart here. It is the iShares Semiconductor ETF. And this ETF in particular, we call it the SOX ETF. There it is. You can see this is a very important index because chips represent so much of the tech market. Tech represents almost 50% of the S&P 500. So one could actually say, as chips go the tech sector, which goes the S&P 500, and we know NVIDIA makes up almost 10% of the SOX index itself. So as goes NVIDIA, goes the market. Well, I don't think it's a stretch to say that. So NVIDIA earnings that will be coming out on the 20th of November will be a very important number for the markets. And they usually report, and I believe they do report after the bell. And the last couple of charts I have on NVIDIA, we can see operating revenue. And you can see operating revenue has actually started to come down a little bit with NVIDIA. There it is, but still doing tremendously well. And our last chart here, profit margin. Profit margins continue to be quite good at NVIDIA. Many people, including myself, believe that over time, as we get more competition in the AI space, profit margins will start to pull back from, let's say, that mid 70% range to somewhere maybe in the 60s and even 50s, as names like AMD and other chip makers challenge NVIDIA for their dominance. The third point or idea that I want individual investors to keep their eye on is all the economic, US, I should say, economic data that will be coming out and has already come out. As I mentioned earlier on our show, just off the top here of this segment, CPI, Consumer Price Index in the United States, came out this morning. And I think the biggest thing, and we have a chart on US CPI, you can see here the biggest change, or the only change, is that the headline number has gone from 2.4%, actually higher, to 2.6%. Core CPI, or core inflation, which strips out volatile energy and groceries or food, is remained at the same at 3.3%. So CPI is important because that will give an indication to investors and the Federal Reserve as to what inflation is doing and how they should react at the next Fed meeting. We're going to see the Fed and the Bank of Canada have one more meeting in December before the end of this year, where they will set policy, and it is anticipated that the Fed will cut a quarter point. It is anticipated that perhaps the Bank of Canada may cut another 50 basis points, but we will have to see. So keep an eye on today's market and the next few days based on the inflation data. Next chart we have is on the US dollar. And you can see how strong the US dollar has been against a basket of major currencies around the world. You can see US dollar actually at multi-month highs versus major currencies around the world. Our next chart here shows US dollar versus Canadian dollar, and it shows roughly a 72-cent dollar. That actually is a little bit behind. It's now less than 72 cents in that 71.5-cent range and falling. And it is falling because right now it is anticipated the Bank of Canada will continue to lower interest rates faster than the US will. Economy in Canada is not doing as well as in the US. We don't have all the tech and AI that they have in the US, more commodities-based energy or base metals. And that's just not doing as well over the last little while as tech. And I think that has a lot to do with what's happening with the Bank of Canada, their actions, and obviously the effects on the dollar. Another point to consider, again, before you make your investment decisions, is this idea of where interest rates are in the United States. And again, we always look to the US because what happens in the US affects our markets a lot more than what happens here in Canada. We have our US 10-year Treasury. You can see how much the US 10-year Treasury has gone up recently. Not a good sign for the markets. Markets start to get a little jittery when that 10-year started to approach 4.25, 4.30, and now over 4.4% on the 10-year. We also have the 2-year. It's almost an identical chart. The 2-year is now up above 4.3%. At one point, it was actually inverted with the 10-year, but now it's It's come back, and the 2-year is now under the 10-year rate, but 4.34% is definitely a lot higher than it was just a short time ago. So once again, I think from an economic perspective, from a data dependent perspective, I think you want to look at those three things. You want to look at inflation, you want to look at a dollar, the US dollar in particular, and its strength. Its strength will have an impact, on Canada, Canadian imports, Canadian exports. It'll have an impact on Canadian business. US is our largest trading partner. And lastly, you want to look at US interest rates, where the rates are in the US. You also want to look at Canadian interest rates. But for the markets, from the market standpoint, US interest rates affect stock market movements a lot more. So those economic data combined with NVIDIA earnings and looking or keeping your discipline when making investment decisions, those are the three things that I think you all should be watching before you make your investment decisions over the next few weeks. Election results. How did the market react? Well, we all know, right? We knew the market surged higher. But as I said earlier, we had a lot of winners and maybe not so many winners in certain areas of the market. A lot more winners than losers, which is great for the stock market. But in certain areas of the market, we saw a lot of struggles. And that really depended on what former President Trump said on his campaign, during his campaign, on his campaign stops, at his rallies. What did he say? What sectors of the economy did he not like? Did he bash at times? What industries was he concerned about? What countries did he comment on and wasn't too fond of? The wars and the war against in the Middle East and China and everywhere else that he made comments about. That all had an effect on the stock market the day after former President Trump, or President-elect Trump now, it was determined that he would be the next president. So thought we would just go over some of the winners and losers from that day, or really ever since we found out that the president would be elected or be the next person in the White House. So our first chart, actually, it's a group of 4 charts. One of the winners of a President Trump victory was really the stock market in general. And you have here the 4 major indices in North America: the Dow Jones, how much it went up, the S&P 500, the NASDAQ went up quite a bit, and even the Toronto Stock Exchange, the TSX, went up significantly. So major winner, all the indices. And that's why you saw the gains that we had the next day, and really the gains that we've had over the last week or so. All the markets are significantly higher. Another big winner, Tesla. Tesla stock went up significantly. Tesla is now back over $1 trillion. The CEO, Elon Musk, now worth over $300 billion. That's billion with a B. The richest man in the world today. He obviously was very active in pushing for President-elect Donald Trump to be the next president of the United States. And he was at his rallies, and he had his own rallies for the president. And now we found out just in the last 24 hours that he will be part of a task force for the White House, trying to figure out efficiencies in the economy, try to get rid of waste and become more efficient in terms of the spend of the federal government in the United States. So if Elon Musk doesn't have enough on his plate, he's now going to be working for or with the federal government. So Tesla had a pretty big surge, actually a very large surge. Another big winner of the election, Bitcoin and digital currency in general. And you can see here how much Bitcoin surged when it was realized that former President Trump will be the next president of the United States. On his campaign tour, President Trump made mention or referred to Bitcoin and talked about how he wanted the United States to be the Bitcoin capital of the world. And obviously, Bitcoin had a major surge. A lot of Bitcoin investors very happy to see this, very happy that President Trump will be again the president shortly, I guess come his inauguration, I believe, in January, and very good for Bitcoin and Bitcoin investors. Next chart, U.S. financials, bank stocks, large bank stocks. Smaller bank stocks, regional banks, all went higher. And here's a iShares US Financials ETF. Why did the bank stocks go up? Because once again, former President Trump on his campaign tour talked about getting rid of regulation. Too much regulation in the United States. Can't get anything done. Businesses can't buy other businesses. They can't merge. There are no, very few companies going public, etc. Well, former President Trump wants to put a stop to that. He wants regulation to be cut and make it a lot easier for businesses to conduct business. And so what is one industry or one sector of the market that will benefit from deregulation? US banks, probably the most regulated industry. Talk is that US banks will have a lot less regulation in certain areas. And if that does happen, they will benefit from that. So these are just some of the winners, some of the big winners. What are some of the losers? Well, our first chart here, the iShares Global Clean Energy ETF. So let's talk about clean energy. President Trump, former President Trump, talked a lot about oil and oil production. I think his term was drill, baby, drill. We know the United States is the largest oil producer in the world right now, but he wants to see that oil production go even further. And so what is he not so keen on? Well, clean energy. So a lot of clean energy stocks. There's the iShare ETF for clean energy. That group of stocks and that sector of the market went down. Invesco Solar ETF is another ETF that we have to show you. Solar stocks, again, another form of energy, not oil, not natural gas, but solar. Those stocks went down as well. Once again, based on what former President Trump had said over the past, 6 to 12 months. Again, pushing energy, pushing oil, not so keen or not talking as much about solar energy. We have a chart on Taiwan Semiconductor, and you can see that Taiwan Semiconductor sold off, global chip maker, biggest around. They have their customers, NVIDIA, Apple. Taiwan Semi dropped. Why? Well, again, former President Trump talked about how Taiwan has stolen the chip industry from the United States. Names like Taiwan Semi, doing business in Taiwan. He wants to bring everything back to the United States. So names like Taiwan Semi went down. Names like actually Intel went higher. So Taiwan Semi, a loser there. And last but not least, we have a chart, what we call this, the Crane Shares, CSI chart, China Internet chart. You can see Chinese internet stocks. A lot of these Chinese internet stocks trade on the New York Stock Exchange, whether it's JD.com, Pinduoduo, a lot of names that are Chinese, domiciled in China, but trade in the United States. A lot of these stocks have pulled back. Alibaba, probably the most famous Chinese stock. So a lot of Chinese names, unfortunately, did not have a good day. Again, based on a lot of talk that former President Trump comments he was making about China and the relationship between them, the United States and China. So a lot of winners and losers. I think just depending on where you were in the market, you probably had a great day. But if you were in some of these international names, other forms of energy, Taiwan Semi in particular, unfortunately, you didn't have the best day. So again, overall, markets seem to surge, but with any election, there'll always be winners and losers. So what should an investor do on a hot trading day like we saw last week, or any hot trading day? We have a chart here. We call it the return of the Trump trade, or the Trump bump, as some were calling it. So what should investors do? We've already talked about sticking to your discipline, but on that day after the election, simply put, I didn't do anything. I didn't buy. I didn't really sell. I just kind of took a step back and watched. Some people call like things like that the 3-day rule. They'll wait actually 3 trading days before they actually start to do things. I usually wait 24 hours or 1 trading day. So I took a bit of a step back. I did make a few trades that day, but they were based on fundamentals and for other reasons. There was no Trump bump considerations over here in my office. you want to take a step back because you really never know how the dust will settle. As I showed you earlier, a name like JP Morgan surged, that day and then pulled back the next. So I guess my message regarding what should investors do on a hot day? A lot of people will just jump in, as I said earlier, with 2 feet in the water, and sometimes that's just not the right thing because cooler heads prevail and the market sells off. Sometimes you hold back, and actually the surge continues, and you feel bad because the surge you kind of missed it. So you can never really win, and so that's why, as I said earlier, you want to stick to your discipline. You want to buy if it makes sense, not just because there's a lot of hype, but because fundamentally the investment idea makes sense and also matches with your investment objectives. I know a lot of people on the day after the election bought stocks, and those stock ideas didn't even make sense from their investment objective perspective. They were buying it just because they saw things going higher, and that's not a reason to buy, and that's also not a reason to sell. Again, you want to make sure that you're doing things for the right reason. So on a hot trading day, even though we saw the gains that we just showed you on that recent chart, I think you just want to take a step back, take a breather, give yourself 24 hours, maybe 48 hours, and then make intelligent decisions with your investment portfolio. So will Canada need to cut taxes to stay competitive with the United States? As I said earlier in the show, we had on our show three tax experts, a panel talking about perhaps cutting taxes. We talked about the idea of this tax fairness concept. We spoke a bit about really where taxes could be, should be, maybe even an idea of a flat tax was spoken about with our panel. But this now idea that the United States is going to cut taxes, that Donald Trump, when he gets into the White House, former President Trump, will cut taxes, will cut corporate taxes. How can we here in Canada stay competitive with our neighbors to the south? And we just have one chart for this topic. And I think it's just, in my opinion, the best chart of our show today. And we can show it here. And there, simply put, U.S. corporate tax rates could soon be the lowest across OECD countries. And it says the lowest or the highest because when this chart was created, we didn't know who was going to win the race. And you can see at the top, United States Trump proposal, the red, that is what former President Trump is proposing for corporate tax rates. They will be the lowest across all major countries, OECD countries in the world, if he can put through what he wants to put through. On the flip side, if Vice President Kamala Harris would have won, they're actually the blue line at the bottom, which is would have been one of the higher rates for corporate taxes in the world today. So to stay competitive with the United States, because as we know, former President Trump will take office in the next few months. Will Canada cut rates? In my opinion, I think they have to. I thought Canada had to cut taxes even before former President Trump won the election. So will we see this? Will we see this by our current administration here in Canada? Will Prime Minister Trudeau think about or talk about cutting taxes, or will it take a regime change? Will it take another election, a new government being formed, either conservative government or other, to cut taxes? I know there's been some talk by conservatives that they indeed will be looking at taxes, perhaps cutting taxes if they are elected. So I guess my opinion is, yes, I think we will have to cut taxes, and I think we will see a cut in taxes, especially if we do see a change in government. And I think many businesses, many individuals, high net worth, middle class, lower class, I think everybody would be quite happy to see a cut in taxes in some capacity so that we can continue to be competitive with our neighbors to the south. Quick hits, part of the show where I touch on three ideas that some of you may have seen, or many of you probably have seen in the news today. First one, Warren Buffett's increased cash holdings makes investors nervous. We're hearing a lot lately about how Berkshire Hathaway has been selling off shares of companies like Apple and Bank of America, building up a pretty large cash reserve. Do they know something that we don't? Not sure. FOMO, fear of missing out. What grip does it have on investors? We touched on FOMO on the show already. Fear of missing out is a powerful thing for investors. Sometimes gets investors to do things that, well, they may or should not be doing. Will poor job numbers in Canada lead to an oversized bank rate cut coming up in December? There's a lot of talk that with the recent numbers, jobs data out of Canada missing by quite a bit, will the Bank of Canada cut another 50 basis points? Well, I think that is a very big possibility. So let's talk about the first one, Warren Buffett. We actually have here his Berkshire Hathaway's two main stocks. There's an A and a B. So Berkshire Hathaway, it's A shares, $700,000 per share. That's not a mistake. That is actually one share is worth 700,000. I remember when shares were 100,000 many years ago. Now they're up to 700,000. We have the Class B for those that can't afford the Class A shares. Well, you can go into the Class B shares, only 466 US dollars per share. So quite expensive. And as we said, or as the headline says, right now Berkshire is accumulating cash, selling off shares. I think they're doing it for two reasons. One, Warren Buffett is sort of stepping away from the business, and I think he wants to leave behind a lot of cash so that the new individuals that are going to run the company can make changes. I also think that Berkshire is a value business. They are a value shop, as we would say. So they're looking for value. And right now, values are a little stretched. So they're taking profits and they're not putting as much money to work. So I think in two ways, for those two reasons, that Berkshire is accumulating cash. I don't think investors need to be too nervous about it, although it is a sign, in my opinion, that valuations and the overall stock market is starting to be a little bit stretched. Next quick hit, FOMO, fear of missing out. When you combine fear of missing out with our old acronym that we haven't talked about in a while, TINA, there is no alternative to the stock market. Combine those two things, and many believe that those two things have been the cause of the stock market or the S&P 500 making 47 new highs this year. We actually have a quote here, which I'll read very quickly. Investors' fear of missing out on a two-year bull run has helped the S&P hit 47 record highs this year. And this momentum shows few signs of waning because if investors want equity exposure, there is no alternative to the United States, at least not if the relative strength of the US economic data and corporate profits is your guide. In many ways, the latter trend is feeding the former, and the symbiotic relationship between the two only seems to be getting stronger. This was a quote out of Reuters. So FOMO and TINA coming together to produce new highs seemingly on a weekly basis. Last but not least, our last quick hit is this idea of the Bank of Canada. Will they make a supersize cut? You know, when I think of the word supersize, I think of McDonald's, the supersized French fries. But in this case, we're talking supersized interest rate cut by the Bank of Canada, 50 basis points. I'm hoping they don't do it. I know many of you might be a little angry at me for saying that. I just get nervous that if we cut too fast, I think we raised interest rates too quickly in this country. I now think we're cutting too quickly. I don't think the Bank of Canada has its finger on the pulse. That's my opinion. I think they're kind of flying by the seat of their pants a little bit. And because of that, I think they raised rates too much, and now they're having to cut them too quickly. And, I definitely call into question what the Bank of Canada has going on or what they're thinking. And perhaps if they do continue to cut as aggressively as they have, what is that going to mean for our housing market? So based on our housing market, I'm just concerned that they may cut too quickly. And our last chart here is Canadian jobs. Canadian job market slows, and you can see how quickly the jobs market has slowed. And I think that is the main reason why the Bank of Canada is considering a 50 basis point cut. So a bit of a longer show today. So I wanted to get to one question that we received after our last show. And question reads, Canadian dollars decline. What does it mean for imports, exports, and inflation? Would the increase would this increase the value of assets? Well, we've touched on a lot of that already. What does it mean for the dollar? Well, I think that the Canadian dollar is falling because, as I mentioned earlier, we're seeing a lot more aggressive interest rate cuts here in our country because of interest rates coming down a lot quicker than in the US. So we're seeing that decline in the Canadian dollar. What does that mean for imports and exports? Well, if you are someone that or a business that is exporting, your exports are now cheaper, for example, to the United States and even to Europe and other parts of the world, so that you could perhaps sell more. So good for exporters. For importers, not so good. What we're bringing into our country, especially out of the US, is costing us a lot more. And eventually, if our dollar gets too low versus the US dollar, that could mean prices go a lot higher. And as we know, higher prices, higher inflation. Could we start to see inflation creep back in to Canada? So not good for imports, good for exports. And in terms of increase in the value of assets, I guess it just depends on what assets you hold. If you hold US denominated assets, very good, right? Because when you repatriate those assets back into Canadian dollars, it means a larger amount for you. So anybody who does business in the United States, when you bring back those earnings and that revenue back to Canada and do your income statements back in Canadian dollars, it just gives you a boost. So with that, I want to say thank you to everybody who watched our show today. Again, information packed, Swiftonomics. Hopefully many of you watching will be able to catch her concert and go to it live. Something definitely to see. And again, want to thank everyone for taking the time out of your busy day. And I look forward to seeing you all once again 2 weeks from today on November the 27th at 12 noon. And until then, happy investing.